Hi, I'm Midas of Midas Investing, and today we're going to be taking a look at ticker NFLX, otherwise known as Netflix. We're going to be taking a look at an overview of the company, its history, and its most recent performance in the last fourth quarter and fiscal year, as well as an overview of my valuation of their stock. If you appreciate in-depth business analysis like this, go ahead and give the video a like and subscribe to the channel. That way you get notifications whenever I go live or whenever I release other videos such as this. Netflix is a company we've covered a few times on the channel before, and previously my valuations had definitely shown them to be significantly overvalued. And what with the performance in the last year, what with them coming pretty significantly down from their peak levels, it's interesting to see just where their valuation may stand comparative to our projections for their fundamentals for the future. So taking a look at the release from their fourth quarter earnings, as we have right here, we can see that the year-over-year growth of revenue as of the fourth quarter was about 2%, which is a pretty far cry from the year-over-year growth that we had in previous years, much higher in the teens or even in the 20s in previous years. You can see that kind of growth rate starting to shrink over the quarters over the previous year or so, as well as the operating margin has also come down pretty significantly. I believe this is on the quarterly level of 7% versus more in the range of 20s in previous timeframes. Also, the EPS has also come down pretty significantly during that time frame. They mentioned in the commentary up here about how some of the reasons for the strong performance in the fourth quarter is from some of the really popular series that they had, including the Wednesday series, which I myself have not seen, but I definitely know a lot of people who watched it and really enjoyed it, as well as Harry and Meghan, which is apparently a very popular documentary series following the British royals, as well as the Glass Onion sequel, Knives Out, which I actually did see Glass Onion or Knives Out, but I've heard really good things from both of them. So apparently they had some really good releases in the last quarter or so, which definitely boosted their numbers a little bit. Also in the last quarter, they did a more formal transition, something for their CEO. They've been kind of in the process of doing this for the last couple of years, with Reed Hastings, their current CEO, or previous CEO, I should say, being now replaced by Ted Sarandos and Greg Peters, which actually come over to their governance page that they have over on their website. And it shows Reed Hastings here, who is in fact the founder, one of the co-founders of Netflix back in 1997, and he was CEO for the vast majority of the time in between. I believe he took a step back for a year or two and then came back up through this last year or so. So the two new gentlemen who are now co-CEOs, Greg Peters that we have right here. Greg Peters joined Netflix in 2008, and prior to that, he worked in multiple industries of consumer electronics as well as in digital entertainment, showing that he's definitely a pretty strong contender to be CEO of a major tech company. And then Ted Sarandos, who has been working with Netflix for quite a long period of time, particularly as one of their content heads, which gives him a huge understanding of what it needs to produce the high quality content that is starting to really push itself globally. He was behind the teams that acquired and developed the shows such as Stranger Things, Sacred Games, The Witcher, The Crown, Bird Box, Red Notice, many other things such as that. Another interesting person on the leadership team that I think is worth mentioning, as I kind of said right here, Ted Sarandos was previously one of the content heads, so it's kind of worth noting the now new chief content officer, Bella Bajaria, I can't pronounce that last name, forgive me for that. But the content officer seems to be one of the most important positions within this company, considering they're going to be, it is a content company. That's the vast majority of their assets, the vast majority of their revenue. But she's the new content officer. So following her career is probably going to be pretty important to thinking about the future for the company as a whole. Now, doing a little bit of a wider search on the internet, trying to find some articles about some details related to Netflix, getting a broad picture of how I want to project numbers for them, I came across this article from Truelist, which covers a lot of statistics related to their most recent kind of growth, and I thought it was pretty useful, especially a few specific details that I'm going to be using in my projections for the future. Then down here, it disaggregates the type of content by device that it's being streamed on. Apparently 70% of content on Netflix is being streamed on a television device, as it kind of shows by this pie right here, with 25% of the signups coming from there. 40%, the lion's share of signups coming from the laptop, next followed by 30% on mobile. It's interesting to see that what used to be very much a very mobile focused company is now 70% of the watch time in total on television. And that's doubly interesting when you think about it comparative to the small amount of total television watch time that Netflix actually makes up. Then further down in this article, it has some details related to some of the users on Netflix. The average Netflix user in the US has an annual income of less than $50,000. And if you mix that with the median age of Netflix's core subscribers between 35 and 44, as we have right here, that kind of tells you that it's not necessarily a super high cost choice. So people who have higher incomes might be choosing higher cable packages. So people who are on the lower end of the income scale are choosing Netflix over a cable package is basically what that tells me. And then if you actually look at the distribution of the age groups within here, it shows you that the high income earners, the people who have the most money to spend on actual content watching, is going to be the 35 through kind of 54 range, and that makes up this 37% or so of the total demographics of Netflix, whereas the 18 through 34 group makes up about 30%, and that's pretty interesting to see, especially considering some of the later details that I'm about to get into. And then you can bounce that off with the 32% of 55 and older, which are the section of the populations that are going to stop spending as much on content over the next couple decades as they move into retirement or so. So these are the people that are going to be spending on content in the future. These are the ones that are currently the high income earners that are going to be so for the next while or so. And you can see that this has kind of been on a little bit of an uptrend moving into as it moves into the older age groups. Now mix that statistic above, about 30% of Netflix's users being between the ages of 18 to 34, with this statistic that shows that Netflix is the most popular amongst younger people, as 75% of 18 to 34-year-olds have Netflix, according to Netflix statistics showing. As you can see right here, 18 to 34-year-olds have 75% of them have access to a Netflix, and then 35 to 44, 72%. And then as it moves older, you can see lower chunks of it. So basically the older groups of people, the people we were just talking about leaving the content spend section of their age grouping, are the people that have less access to Netflix, versus the younger people have much more access to Netflix, even though they're not the ones that are spending the most money on it. So what that shows me between those sets of statistics is that in the future, these people are going to start to spend more money on Netflix because they're already essentially hooked onto it. It's their preferred platform. Now, coming down even further, it has a few specific details focusing on geographic regions for Netflix and how that relates to some of their numbers. You can see on this map here, the monthly ARPU by region, showing that clearly the United States and Canada is the most expensive region, the people who can spend the most on content, with the next highest group being Europe, Middle East, and Africa. And it's also worth noting that Europe, Middle East, and Africa, the EMEA region, is also the next highest region in terms of total revenue from which they're actually getting their total sales. So this is the second most important, which is good considering the overall ARPU being significantly higher, these being more indicative of growth regions for them. But also mix that with these penetration statistics that they have right here. Projected penetration in North America by 2025 of 62%. It does compare that to the current level of 55% in 2019, and then it has of 19% in EMEA versus 41% projected, and then Latin America is expected to go from 39% to 53%, and Asia is expected to go from 11% to 25%. So I'm using both the current penetration rates and the average of them over the entire geography, comparing that with the projected expected ranges. I'm going to be using that as part of my projections for the future revenue. All right, now one other piece of outside research that I was going to rely on for my future projections is this article from Grandview Research, which I'm a big fan of a lot of their research reports. Just a specific detail of them talking about the video streaming market being estimated to be worth about $331 billion by 2030 or so, which comes out to a CAGR for the industry of about 21%. So I'm using this as a baseline for my estimates of the market in the future, but we'll definitely be making our own assumptions about whether we think it could be better or worse within a certain range or so. All right, so now that we've taken the time to cover some of the details related to the overall streaming industry and projections based off of Netflix's most recent statistics, I wanted to dive into some details from Netflix's 10K that I think is super relevant to understanding their financials and how that's relevant to making projections for the future accurate in terms of understanding what real cash flows for the company is. So in the notes section of their 10K, which is below the financial statements, I went to the section labeled content because they give a very strong description of a lot of the details of how they deal with the cost of content and how they deal with how content is put on their balance sheet versus amortized away in terms of thinking of it as an expense versus capital expense. So skipping down a little bit further, it says right here, the company recognizes content assets licensed and produced as content assets net on its consolidated balance sheets, and for licensed content, the company capitalizes the fee per title and records a corresponding liability at the gross amount of the liability when the license period ends. Basically, that means that when they produce content, they take the amount of money that they spent on the content and they put it on their balance sheet, considering that an asset. Based on factors including historical and estimated viewing patterns, the company amortizes the content assets licensed and produces in cost of revenues on the consolidated statements of operations over the shorter of each title's contractual window of availability or estimated period of use, or 10 years beginning with the first month of its availability. So basically what that means is that then they then subtract from this asset base a certain amount and into their cost of revenues, which means it's part of their COGS and comes out of their gross margins, a certain amount of expense of those amortized content costs over a certain period relevant to the availability of that content, or how long that content is being watched, or 10 years, whichever happens to be the shorter. It's basically a certain set of rules to guide how quickly they expense that information away. They also include some specific details here talking about how the amortization comes on an accelerated basis. The company typically expects more upfront viewing, which makes sense. Content is more popular when it's first released, typically speaking, rather than later on, although with some exceptions. And films are typically more popular more recently from when they were released compared to TV series amortization. So they amortize at a faster rate for films. On average, they say over 90% of licensed or produced content asset is expected to be amortized away within 4 years of its month of the first availability. So basically that means like they put an asset on their balance sheet. On average, about 4 years later, that asset has left their balance sheet in terms of it being amortized away. So effectively speaking, that means that if they get people to watch content that's on average about 5 years older than when it was produced, then they're effectively not going to be getting any excess cost of revenues applied to them based on that. So the higher quality content they can produce, that can be watched later on. If they can produce content that people want to watch a decade later, effectively speaking, that becomes extra cherry on top, so to speak, in terms of profitability. If we come down to their cash flow statement, which is in here, you can see that it starts with net income as a typical cash flow statement does, and then you add back certain non-cash charges like depreciation and amortization. And what are we talking about? Content amortization. So there we have it, amortization of content assets, 14 billion being added to net income during that time frame. So 14 billion worth of non-cash charges that are added back to net income when calculating cash flows for the company. But don't stop there, because that doesn't take into account current content spend. That only takes into account the previous content spend that was put on the balance sheet and is now being amortized away. You have to take into account the amount of current content that is being produced each year. And that shows that right here in a negative number, almost $17 billion worth of additions to content assets right there. So between the net of that, they actually have a negative 2.8 billion or so, give or take, in the cash flow from operations that comes from content spend. And that's just in this particular year. It depends on the year, give or take, which one is ebbing and flowing, which one happens to be more or less. So with that brief overview of how content spend works, let's hop over here to the financial statement spreadsheets that I have for the company. Taking a look at the annual statements of the income statements right here, you can see the growth of the revenue pretty dramatically over the last 10 years, but you can also see that kind of starting to level off a little bit, with the growth rate definitely starting to come down significantly. Coming down and boiling into some of this more specifics, we have the cost of goods, the cost of revenues, as we were just discussing, versus the gross profit over time. So you can see that cost of goods grows pretty dramatically alongside the revenue overall, but you can see that the gross margin, which is the difference between the two, it has started to ebb upward a little bit over time, reaching pretty solidly over the 40% line in 2018, and then kind of staying solidly above that ever since. So that's good for them that they have managed to grow their gross margin line, especially considering, like we said, the content spend is above that. So effectively speaking, that's part of their capital expenditure is hidden within the cost of goods. And so the fact that they can make the gross margins still grow is very good for their returns on invested capital, effectively speaking. Focusing in on more typical operating expenses, the SG&A as a percentage of sales, you can see that has definitely had a pretty consistent kind of trend for a long while there, being in kind of the mid-teens, and then it's kind of dropped pretty significantly over the last couple of years. It's definitely a pretty solid argument about whether or not they can maintain that. It's definitely a little bit more worrying in my opinion. I would argue that this would probably come back up at least maybe part of the way towards the longer term average over the long run. This gross margin increase I can see is sustainable, but the SG&A as a percentage of sales decrease I see as less sustainable. Now coming to this graph over here, which shows the development capitalization, which is taking their R&D costs, because they actually do have technology R&D costs. This is separate from the amortization of the content spend that we were talking about. the R&D costs that they have, which is technology growth. They have R&D as a percentage of sales, which has been solidly in the kind of single digit percentage range. It was a little bit higher back in the past, and it kind of swooped downward into some lower range over the 2017 through 2019, 2020 timeframe. And then over the last couple of years, it started to edge back upward. I would say that's very good that this kind of movement backward upwards has occurred, because that is going to be important for them to be able to sustain their technological development over the long run. And you can see that they've done a good job of that by seeing that the net R&D, which is the amount that's left over after the amortization effect of my capitalization process, is growing significantly over time. Coming over to the annual cash flow statements and focusing in on the cash flow from operations graph as we have right here, this really can paint the picture of what I'm talking about, of how the content spend as part of the working capital numbers, huge, massive negative cash flow numbers right here in the change in working capital, with a pretty huge, significant positive depreciation and amortization numbers in positive territory as well, which is where the amortization of the content is. So the huge balance between these two shows just how the vast majority of the cash flows of the company is hidden within this cash flow from operations way of dealing with the content spend. If you do, like I said, include the change in working capital as well as the net R&D, as we talked about in the previous slide, this gets a picture of the total net reinvestment of the company over the entire time frame of the 10 years, and a percentage of that as a percentage of sales, which is interesting to see. We can take a look at the reinvestment as a percentage of sales. You can see that over the entire 10-year time frame, I'd say maybe kind of an average of maybe a little bit less than 20% is pretty good, pretty typical for them. 20% as a percentage of sales. And you can also see a pretty interesting, this huge divot downward in the overall reinvestment as a percentage of sales in 2020 that bounced back upward in 2021 and 2022. And the reason why I point out the 2020 huge drop in reinvestment overall is because that's also the year in which they reached their cash flow positive. And it's not a coincidence at all that the year in which they had massively less reinvestment, as you can see in this graph right here, is the year in which they ended up reaching a cash flow positive year. Now they have made a huge rebound in the reinvestment, and they are back to cash flow positive in terms of the way I calculate cash flows, but obviously they did dip down a little bit in the interim a little bit there. Now, one more thing I kind of wanted to point out in the financials spreadsheet before moving on to the valuation and other details of this is to narrow in on the reinvestment rate, as I was just talking about. The reinvestment rate, I was saying, over the last 10 years on average has been kind of like maybe in the range of about 20% or so. If we look at the last trailing months of the 4.5 years we have here, the reinvestment as a percentage of sales, which is this line right here, ends up being on average about 22%. And if we look at the reinvestment rate, which is that same reinvestment as a percentage of the after tax operating cash flows, we narrow in on that, that actually ends up being closer to more like 140%, which means that effectively they're reinvesting much more than their operating cash flows in terms of getting that growth. However, if we actually focus in a little bit even more closely, you can see that that itself is starting to decrease pretty steeply over time. These several hundred levels of reinvestment rate way back in 2019, 2020 versus in 2021 through 2022, it's more like an average of 94, 95%. So you can see that the actual reinvestment rate, which is reinvestment as a percentage of after tax operating income, has basically been cut in half just over the last 2 years or so. Which is going to be important about thinking about, well, how much reinvestment are they going to do in the future? Potentially, they could cut that reinvestment rate in half once more. So hopping over here to this extra spreadsheet I have to focus in on some of the details of Netflix so that we can build up our valuation from that. I did take their revenues for the last 10 years and put it up here. And then I compared that to the overall subscriber base that they have at the end of each year, and also the growth rate for each of the years for both of those metrics. I also include the average subscriber fee for these particular years, which would go maybe a little bit better in line with the average subscribers, but I wanted to use the year-end subscribers partially because I had it for more years going back further in time, and I wanted to get a good set of statistics for this. But point is, I just kind of wanted to narrow in on the growth of revenue compared to the growth of subscribers versus the growth of the sub fee being charged to the subscribers. If we focus in on that, you'll see for the first 4 years of this, this is a 9-year period, which gives us 8 years of growth. So I want to narrow in on 4 of those growth years. For the first 4 of those compounded periods, we have an average for the revenue growth of 30%, which over the next 4 drops down to 19%. If we look on the ending subscriber level, subscribers grew at 25% clip, and then that shrank down to a 13% clip over the next 4 years. And the average sub fee went from a 6% growth down to a 3% growth, which is pretty interesting to see that it's such a low number for the actual fee growth relative to the overall subscriber growth. That's kind of been part of their strategy is to not grow the fee too dramatically as quickly, regardless of the kind of the general opinion, I think, in the zeitgeist about Netflix raising their costs all the time or something like that. But either way, I wanted to see, well, what ratio is the second set of years versus the first set of years. For revenue, it's about a 63% of the growth rate, 54% of the growth rate for subscribers, 57% of the growth rate for the fee. On average, that gets us a ratio of about 58%. So I was like, well, what happens if the growth rate drops by that percentage again? We would get revenue growth of 11%, subscriber growth of 8%, and the average fee growth of about 2%. If we just focused on the revenue growth, because obviously if you have a revenue growth, you don't need anything else. You can just project based off that. If I just had 11% revenue growth, that gets us revenue of just under 90 billion per year in 10 years from now. If I wanted to focus in specifically on subscribers and the sub fee and build up from there, that would at 8%, that would get us potentially 489 million subscribers in 10 years, with potentially a sub fee of $14.25 per month. Which if you multiply all that together, annualize it up to the annual amount, that would get you about 84 billion or so in total revenue. So that's just one relatively simplistic way based off of just a declining growth rate that you can build up revenue for the company. I wanted to do something a little bit more specific, thinking about the actual industry as a whole, which is partially where those the article related to the market size that I talked about, as well as some of the details from the Netflix statistics article that we covered earlier. Focusing in on some of the details, I actually have it right here. The projected 2030 market for global video streaming, according to that one article, was $330 billion or so, which I have right here. The current portion of that of the spend of the global streaming market that is North America is approximately 1/3. That's a rough ratio. I just decided to use that, and we're going to assume in the future that it could be approximately that, give or take, in different circumstances. So we're going to use that as our estimate. So approximately that gets us North America streaming revenues of about 110 billion, and then the rest of the world about 221 billion or so. The market penetration for North America, according to the other article we were looking at in 2019, was about 55%, and for the rest of the world, on average, it was about 22%. Now, I built up a best case scenario and a worst case scenario revenue based off of a few different modifications of these assumptions. I'm assuming that in the best case scenario, maybe the global market is actually 10% better than what they're expecting. I think that this is actually probably a pretty rosy assumption, so I didn't want to do too much higher than that assumption in the best case scenario, but I did allow for some potential upside in terms of what the market size will actually be. In the best case scenario for the percentage of that that's going to be North America, I'm just going to assume that it maintains the same 33%. North America is already about 1/3 of the entire global economic activity in terms of GDP. So it wouldn't surprise me if it kind of stays in that range. But if the rest of the globe decides to grow a little bit faster around North America, that wouldn't shock me either. So I'm going to leave that as the same for the best case scenario, which gets us 120 billion for North America revenues, and then 243 for the rest of the world. Now, based off of the article, we had market penetration projected in 2025 to reach 62%. Now we're talking about 10 years out, not 2025, but whatever. I'm just going to run off of that assumption and assume it reaches the projected 62% for my best case scenario, and the projected 40% in the best case scenario for the rest of the world. Together, that gets us revenues of 74 billion and 97 billion, and that gets us a total revenue projection for Netflix of 172 billion or so in the best case scenario. All right, so in the worst case scenario, we're going to assume that projected market size, it could possibly be 20% lower than the projected 330 billion. That gets us 264 billion for a global market, and we're going to assume that maybe in the worst case scenario, North America's percentage of that actually drops by a few percentage points down to maybe 30%, which gets us 79 billion and 185 billion for the two regions of the world. Then we're going to modify the projected levels. We're going to modify the current levels of market penetration that we have in 2019 by about 25%, assuming that maybe they managed to not actually penetrate those new markets nearly as well, and basically other streaming services grow around them much more than they managed to grow on net, which means that in the 10-year forward period, they actually have market penetration in North America of about 41%, and in the rest of the world, maybe about 17%. That would get them revenues in North America of 32 to 33 billion versus about 13 billion in the rest of the world, which together makes up revenue for the company of about 45 to 46 billion. So 45 to 46 billion for a worst case scenario revenue for Netflix, and maybe 171, 172 billion for a best case scenario revenue for Netflix. And then we can compare that to these kind of more middling, like I said, historic base projections for the potential revenue of maybe about 89 to 90 billion, or maybe 83 to 84 billion. I think 83 to 84 billion is a more realistic way of building it up. All right, now in terms of thinking about their margins, considering the subscription format of their business model, and the overall consistent levels of SG&A and R&D costs that we saw over a longer period of time with just small levels of deviation, I decided I was actually basically just going to build up my margin assumptions based off of the projected ranges of the past for them. So I came and looked at the past and the annual financial statements I have right here, and the 5-year average gross margins for the company is about 39%, with the standard deviation about 1.7%, SG&A, including some other costs, about 15% or so, with a standard deviation of about 3%, and then R&D about 8% or so, with a standard deviation of about 0.5%. So with a little bit of an estimated range based off of the standard deviation, with twice as much upside potential as downside potential, because I do think that their margins are on a little bit of an upward trajectory. So I wanted to allow for that, considering it's a historic range that we're basing off of. I end up with a lower range of gross margin, about 42%, lower because this is the gross margin effect, and the upper being 38%. SG&A 9% versus 17%, R&D 7% versus 8%, and if you add all of those together, we end up with an operating margin range of possibly 26% to 13%. Like I said, lower in terms of costs, not lower in terms of the overall margins. So overall, it gets us a range of 26 to 13% or so, which the average between the two gets us 20%. And considering the average margin over the last 5 years has been about 20%, that's kind of what you would expect. It's not that you would find the average between the two to be anything particularly different. It's more that it gives you an idea of like what potential range of margins it could be on, assuming the future looks like the past in terms of margins. So I'm going to use this kind of 26% to 13% and 20% as my margin assumptions in my valuation buildup. Now, the only other set of assumptions I kind of want to show you before showing my overall valuation of the company is the current cost of capital as I calculate it, with the risk-free rate currently being about 3.5%. I calculate the equity risk premium for Netflix based off of the geographic regions in which they do their business of about 7.4%. And then the unlevered beta for Netflix, which is based off of the industry data set that I'm using. I have the unlevered beta for entertainment currently being 1.02, as it shows right here. I build my unlevered beta into a levered beta using the debt to equity ratio, which they currently have about 10% debt to equity ratio, the current tax rate, which is about 13%, and interest rate is 4.2%. That gets me to a levered beta of 1.11, and that brings me to a cost of equity of 11.7%, which then brings me to a cost of capital of about 10%. Speaking of the industry data set, I'll show a couple other details on here before moving on to the actual valuation, which is that the adjusted operating margins over the 8-year period is about 15% for the entertainment industry. However, if we focus specifically on software entertainment, you can see that the average has actually been more like 23 to 24%. So Netflix is kind of maybe somewhere in between the two. Again, the average ends up being kind of pretty well placed between the two as well. The average of all 4 of those timeframes for both of the industries ends up being 18.8%. And then we can compare that with the sales capital ratio. For regular entertainment, sales capital ratio is actually rather strong, being well over $1, whereas software entertainment ends up being lower than $1, which software typically has lower sales capital ratios, so that doesn't surprise me too much. But we didn't actually focus too much on Netflix's sales capital ratio in the financials, but in the past they had a much higher sales capital ratio. In the most recent history, they've had a lower sales capital ratio, and so part of the argument is whether or not they're going to be able to push it back up towards a higher sales capital ratio, or maybe somewhere in between the two, which gets us closer to about a sales capital ratio of 1 or so. So here's the main summary for the valuation of Netflix, with our projections for the future growth of the revenue that we based it on. I end up with revenue going all the way up to about 101, 102 billion by year 10 in 2032. And we have operating margins moving upward through the upper teens into the 20s, ending up at a terminal operating margin of about 21%. We have their tax rate moving up towards a tax rate of about 25%, and then net reinvestment, pretty significant amounts of averaging of about 6.5 billion per year of additions to capital over the 10-year time frame, which gets them invested capital of about 104 billion compared to the 101, 102 billion of expected revenue, which means we did bring that sales capital ratio close to 1, but not quite all the way up to 1. and that gives them ending returns on invested capital of about 15% into the terminal future, averaging about 15 to 16% over the 10-year time frame. And that gets them expected free cash flows averaging of about 4.6 billion over the 10-year time frame, but ending at about 8.9 billion on an expected basis. Our cost of capital is relatively cheap, especially relative to the cost of capital levels that we had seen, that their current cost of capital being about 10%. I actually projecting their cost of capital will shrink significantly over the time frame. I gave them over the 10-year time frame an expected cost of capital of about 8.2%. And overall, that brings us to a current fair value share price after subtracting out non-enterprise elements of their equity value of $212.97 per share, which is 41% higher than or 41% lower than the current share price. Based off of the cost of equity assumptions that we have implied within the valuation, that gets us an expected 10-year CAGR of only 1%. And also, this is the expected summary of our valuation. We have ranges for each of these assumptions, which builds us a distribution of outcomes, and they are currently placed at about the 89th percentile within the distribution, which is not very good, and definitely not a well-placed position within that distribution. Focusing in on some of those distribution assumptions and looking at the overall pieces of them, this is the actual distribution value, as you can see right here, with a decent amount of potential outcomes actually getting basically a worthless price, but also a couple outcomes bringing it to much higher returns than the current share price, up in the 500, 600, possibly even $700 for a few outcomes. But as you can see, the vast majority and the most popular outcome being between $195 and $217. The current share price being well pushed out towards the end of the overall distribution. You can see that the third quarter outcome being at about $280, the first quarter outcome, which would maybe make it a decent buy price, being at about $140, so significantly overvalued in all of those circumstances. Low expected returns even at the third quarter outcome. These are the ranges of the assumptions that went into the valuation, as we kind of talked about. Cumulative growth outcomes, we had a bull case scenario, which was our bull case that we talked about in our projections, giving them possibly 400% revenue growth, but their bear case scenario gave them only about 60-70% revenue growth, getting us to more of a, while the base case is more like 170%. Showing the range of outcomes for the operating margins, as it shows right here. I have the operating margins in the bear, or in the bull case, possibly reaching 26% into perpetuity, while in the bear case, possibly dropping all the way down to 13%. In the base case, we're sort of assuming it stays around this 20% or so. And that gets us quartiles for the operating income, the third quartile outcome being about 22 billion, while the first quartile outcome being about 13 billion or so. Coming down to the returns on invested capital, we can see the wide variability in the total amounts of capital investment that has to be done over the period, averaging maybe somewhere in the range of about 5 billion per year in the third quartile outcome, while in the first quartile outcome, much lower levels of capital spend, which in turn gives them much lower levels of revenue growth of possibly maybe 2 to 3 billion instead. Returns on invested capital ranges possibly dropping down into kind of the mid-teens, but possibly maintaining much higher teen levels, giving us a pretty decent band of return on invested capital outcomes. And all these things together gets us free cash flow outcomes. As you can see, the third quartile outcome of free cash flow possibly being up to 11 billion, while the first quartile outcome maybe being about 5.4 billion, and the median case being about 8.5 billion. You can see the distribution of those free cash flow outcomes right here, showing that, yeah, the vast majority of the outcomes being more like 5 billion to 10 billion, with some potentiality of going up to 15 or 20 billion or so. And then our terminal value gets us, we have an implied multiple based off of the assumptions of cost of capital that we use. We're showing that under the vast majority of cases, we're expecting their terminal multiple to drop down into below 20 territory, maybe even teens territory, but leaving some potential upside for a higher multiple in the 20s, maybe even up to possibly 26 or so for even a lion's share of outcomes, but definitely not the majority of outcomes. So I hope you enjoyed this overview of Netflix, their business, as well as my assumptions for future growth and how that relates to valuation of their stock. As you can see, I'm finding it to be pretty significantly overvalued based off of what I would say is a pretty rosy projection of the future for them. I'm projecting tripling of their revenue and maintaining of the same operating margins, if not slightly higher, and while also assuming that they're going to return to capital efficiency levels that they haven't had for the last few years or so, while also maintaining a relatively low cost of capital. And even so, I find it to be significantly overvalued. So while it's a very interesting company and I do love analyzing it each year, we're definitely going to be having to pass on it again for now. So if you enjoyed this video, please give it a like. It's the best way you can pay me for the content as we release it here. And if you haven't subscribed to the channel, please subscribe. That way you get notified whenever I go live or whenever I release other valuation videos like this. And if you've done both those things, please join the Discord, the free Discord. The link is in the description below. You can join to be part of the daily discussions we have every day of what's going on in the markets, what's happening with our own portfolios, as well as what we're expecting of our favorite companies and the actions of major investors. So once again, this is Midas of Midas Investing, and I hope you guys enjoyed this valuation video. I'll catch you all in the next one.